Hey everybody, welcome to the Multifamily Freedom Chasers Financing Zoom. My name is Shelly Miles. I am a commercial mortgage broker with Adventure Commercial Capital, and together with Jerry Miles, we will be sharing the financing updates with you guys today. Jerry, you want to go ahead and take it over?
I will. All right. Good to see everybody on here. I think people are going to be a little slow to come on. It's a nice sunny day here where we're at anyway. So I'm guessing people are probably out and about and doing things. But now I'm Jerry Miles, and that's my wife, Shelly, that was just talking. We are part of the Multifamily Freedom Chasers. And I'm having trouble with my computer here. So
If you want to go back and if you want me to go ahead and do the slides, that's fine. I can do it. If you're having trouble.
No, it's coming. It just, all right, there we go. I've got it. All right. So
I don't see it on my end.
Do what?
I'm not seeing it on my end.
Not seeing my screen?
It's saying loading.
Oh, okay. Resume share.
Are you guys seeing it, or is it just me not seeing it? Is everybody seeing it? The slides?
No, it just says loading on my side.
Okay, yeah, it says loading on my side as well. Loading. Okay.
Yep, it's not letting me.
Go ahead and share. I mean, let me have screen share.
Alrighty. And let me try it one more time here.
Maybe I might have too much stuff open on my computer.
All right. Is that better? Can you all see my screen?
Yes, we can see it now.
All right, cool.
Yes.
Well, that is awesome. It is.
All right. I am Jerry Miles. It's my wife, Shelly. Start over again here. We are commercial mortgage brokers, and we're part of the Multifamily Freedom Chasers community. I see we got some people on here that are reoccurring guests, and I see others that I haven't seen before. So if you're brand new, first time on our Zoom here, let us know in the chat. Tell us who you are and where you're from and all those things. So today's agenda, we'll go a little bit through the community ecosystem, and I see Marcel here. So there's nobody better than Marcel to kind of take us through that. I'll let him do that if he don't mind. And then we'll do some introductions. We'll give a current debt market update, and then we'll talk our main topic, application to closing. So then we'll go through some question and answer time. So the Multifamily Freedom Chasers community, one of the founders is on here tonight, Marcel. So if you want to take it away, Marcel, we'd love to have you tell us about the community.
Of course. One of the founders. You are one of the founders too, Jerry. You've been there since day one. But regardless, of course, excited to be here. I was just getting some work done here, and I saw our text message popping up, right? That Zoom is about to start. So I was like, thanks for the reminder. Let's hop right on. But yeah, really, guys, great for you guys to be here. Jerry and Shelly are absolutely awesome people to be around. They're your go-to people when it comes to anything related commercial debt. You can ask them anything. They're always responsive. I don't know how Jerry does it, matter of fact, because he always picks up the phone. He always texts back quick. And I know there's a bunch of people reaching out to him, and he always takes the time for everybody. The patience this man has, I'm very admiring, I must say. So take advantage of that. But yeah, what does the community and this ecosystem look like, right? Every Sunday, guys, we'll try to bring in not we try to bring in, we bring in a bigger level player here. I see Aldo is in here as well now. Good to see you too, brother. We bring in a high level player, somebody that's 10 levels above us, right? That you look up to, that's walk the walk, that can share a little bit of their journey, that can teach a little bit from a higher perspective. But really, who do we really resemble with is the people that are 1 or 2 levels above us, right? Because those are the people you try to follow with. So on Sundays, we just try to get you activated. Okay, what can be possible? Let's get motivated. Let's get excited. And on Monday, we have Peter, who is one of our community leaders, do broker talks. What does that mean? He teaches you how to engage with brokers, how to pick up the phone, how to talk to these guys, how to get them take you serious. And that is the first step, right? Reach out, talk to a broker, get the financials, get the story of the deal, because the financials don't always tell the story of the deal. You want to know why is the seller selling, all this kind of good stuff. You learn that with Peter. Then on Tuesdays, we have Aldo on here right now. They're doing napkin underwriting. I wouldn't even call this napkin underwriting anymore because I feel like this is legitimate good underwriting at this point. I mean, napkin underwriting is good too, but they have taught over the last 8 weeks a different topic every week, to go through how to underwrite a deal. Pretty impressive, matter of fact. So that's what you need, right? You called the broker on Monday, got the financials. Now Aldo and the team teach you on Tuesday how to actually underwrite that. And then you obviously need to know, how does the debt look like? How do I structure this? How do I pay for this deal? And this is where Jerry and Shelly come into the game and teach you what matters on commercial financing, and also be a resource to you and potentially even put a quote for you to give you the money, sell you the money, right, Jerry? Sell you the money that you need to buy your first, second or third or whatever, 10th multifamily property. And we also have Victor here, who is our Freedom Chasers Capital underwriter, who's doing every other week an advanced underwriting session where it's not really necessarily just about, looking at the napkin or looking at small pieces of the underwriting. Is more so also about market research, looking from a bigger picture. Although I know that he's been diving deep into rent roll recently as well, and really taking the time to dive deeper on what the numbers really mean and why they matter. So that's it. That's right now. Our ecosystem happens every week. You can plug in Elevate, underwriting, or multifamily 101 and get freaking started and take action. So with that, I'll shut up, Jerry, now. Thanks for the opportunity. I love talking about this, but this is you guys. You guys have so much more value to add than me.
Well, anytime you show up, I'm going to let you do that part of it, because you do it way better than any of the rest of us. You and Trevor, when you guys start talking about the community, I don't think anybody does it like you guys do. So
thank you, brother.
Yeah. So we appreciate you. So who are the Miles?
Sorry, if you haven't joined the Freedom Chasers Facebook, I just shared the link in the chat. If you guys want to click on that and join, that would be great. Thanks.
Awesome. So who are the Miles? That's us right there. I'm Jerry, and that's my beautiful wife, Shelly. And that's 2 of our boys there behind us in the picture, JJ and Jordan. We have an older one as well, Riley. He's sometimes on these calls, but him and his wife were in Hawaii, so I'm not sure if they're back or not just yet. But yeah, we are commercial mortgage brokers and the founders of Adventure Commercial Capital. We started this business about 3 years ago now. And to kind of give you a background and why we're in this business and how we got started, we still own and operate a commercial roofing business. And we've been in that business for over 20 years now. Quite a few years back, we started investing in real estate. I've always wanted to be a real estate investor, and so we bought our first house. Paid cash for it, rented it out. And thought, hey, this is it. This is what we want to do. And it was nice. We made money. And we got a good deal. But when we went to go refinance the property, we ran into all kinds of roadblocks. Being self-employed, the banks didn't take us seriously, didn't want to deal with us. And then it was an investment property, and most banks don't like to mess with investment properties. So through that process, we ran into some commercial lenders that and commercial lending brokers that just were not real honest. Were overcharging us what we felt were overcharging us. And we kind of had a light bulb moment. I had a light bulb moment in my head, and I told my wife I had found a company that actually trained us to be lending brokers and set us up into business. And I told her, I said, we got to do this business. I said, we can do this business better than these guys are doing us. We could treat people right, and it could be a good business for us. And 2 years later, I finally talked her into it. So, and now here we are, 3 years in, and we've dealt with COVID, and now we're dealing with the raising interest rates, and but we're still kicking, and still in business, and working on growing and building. So I'm glad to be here in front of you guys, a group of real estate investors, and that's why we're here, is because we want to help real estate investors grow and grow their net worths, grow their businesses, and ultimately be able to take care of their families. So that's about us. Would like to give everybody, and before we go on to you guys introducing yourselves, Shelly will be telling her story. She's had I don't know, Stephanie is her name, Dablowski, right? Is that her last name? And she hosts a ladies' night call for real estate investors, for women real estate investors. And she's been on Shelly for a while now to come on and be a guest on the call. And Shelly's really shy and doesn't like talking in front of people. So me and Steph have kind of double teamed her and finally got her convinced that she should do this and that she needs to do this. So June 22nd, she'll be on and be a special guest on that call. So want to push everybody to that call as well, so you can get on and see Shelly. So let's make it the biggest call that Steph's ever had. So,
And I will share the link on our next call here. We'll have one more before I speak. So I'll share the link for that.
Cool. So how am I to this page? Okay. Contact information. Take a picture of this page here. That's my cell phone number. As Marcel said, I've always got my phone with me, and I try to answer all my calls. I try to get back with people when I can't get them, or when they can't get me. So that's our both of our email addresses there as well. So reach out, and we'd love to hear from you and hear about what kind of deals you got going, and hear about your business. And now, who are you? Raise your hand. Everybody wants to. You got time for about 3 people to do about a minute each. If you want to tell us about yourself, raise your hand and tell us who you are, where you're from, and a little bit about your real estate investing experience. Cheryl.
Good evening, everybody.
Good
How
evening.
you doing? Hi. Oh, I just realized my video wasn't on. Sorry, I'm like really like tired right now. I was hoping you didn't call right away, but hi everybody. I'm Cheryl Fahey from Boston, investor, personal care business. I've been in the industry for over a decade. I was a previous owner of the multifamily. I inherited it from my father, and we renovated it, increased the property value by a few $100,000, and did a condo conversion. Was the initial strategy. I was very inexperienced. It was very terrifying experience. And I wanted to get out as soon as possible. But we did sell for a profit of a little over 130K. Yep. So I love this business. And I love your story. And it just really goes to show how much possibility there is. And we can all win. It doesn't have to be greedy.
That's right. That's right. Yeah. And it always makes you like real estate more when you make some money on a deal too, doesn't it?
Yes. Oh my gosh. It's the most empowering feeling, especially being like so underestimated, you know. So analyzing deals in the level that I've seen is just unimaginable. And I'm going to be on a podcast tomorrow. So I'm super nervous.
Well, share the podcast in the chat. So if anybody wants to check it out and hear your story on there, that'd be cool.
Okay. Yes, I will. I'll post it in the, yeah.
Sounds good.
I
Good.
think I got an email about it. Thank you.
Yeah.
Thank you.
And this just goes for everybody to put your information in the chat. You know, we've had people here locally that have met other people in the chat on our calls and are currently doing business together. So you never know who's on these calls. You know, big players, little players, contractors, property managers, lenders, just everybody's on these calls. So put your information in there, and you know, we're all just one or two. You know, we're all one or two connections away from life-changing deals happening. So you just never know who you're going to run into. So make sure that you're sharing your information and letting people know who you are. So
Cheryl, you can also share your information on the Facebook group as well.
yeah.
Okay. Yes. I post deals on there. I got a second commercial opportunity this year, which was major. So I will be in touch on there. Is there another group that we have, or
The Facebook page.
Freedom Chasers Facebook page, which I will share here.
How many
Okay.
people in that group now? Like 13 or 1400 now?
13 plus, 1300 plus.
Okay, cool. So that's a lot of people seeing your
Share the
information.
link. Yeah, Cheryl, share the link for the podcast you'll be on.
Okay, yes, I'm looking for it right now. It's with David DeBow. And he has raised a lot of capital. And I've trained with him for a little over a year and a half. He's very, very intelligent, very skilled. And I feel like I'm gonna freeze. But
you'll do good. Don't worry about it. Get on and just tell your story. You'll do good. You did good on here. So
okay, yes, that's a great start. Maybe this can be practice.
all right. Yep. Thanks, Cheryl.
Thanks, everybody. I hope you had a nice holiday.
Oh yeah, it was great.
Nice.
So we'll jump right in here to the current market update. And you know, where are current rates across the board here just over the last I guess the last 2 weeks, all the rates have kind of gone up. I mean, we've had raising rates, you know, overall as we've been going, you know, as the Fed rate goes up, everybody else's rates kind of go up, but we've been in a little bit better situation because the treasuries have been down. I mean, the treasuries are up from what they were. They were at a half a percent or something, you know, a year ago, but you know, now we're at in the threes. You know, 2 weeks ago when we did this call, we were 2 weeks ago when we did this call, we were at like 3.3. Since then, we've jumped up over 3.8. Now we're kind of around to 3.6 on the 10-year treasury. And this is an important number because we base, you know, the agency debt, you know, Freddie and Fannie, the good debt that you get on these apartments is through Freddie and Fannie. And they're going to base their rates on the 10-year treasury. So when we're looking at the 10-year treasury being at, you know, 3.6, you had 2.5 points to that, you know, and we're up over the 6% range. You get I can't see my mouse here. Hey, Cheryl.
I got it. Don't worry.
Okay.
Click on the screen.
Gotcha. All right. So when we're looking at the 10-year treasury, you know, you take the 10-year treasury, whatever it is that day, you can find that number. You know, Bloomberg, CNBC, there's a bunch of different places you can find that number. You know, add 2 to 2.5 points to that, and that'll give you kind of where your rates will be on most multifamily deals that'll qualify for the agency debt. So when you're underwriting, that's a good guide for you. If you're looking at bridge debt, things like that, you're going to want to look at either the Fed rate or SOFR. Some bridge guys will go off the Fed rate, some will go off of SOFR. But right now, a lot of them are, you know, 5 and 6 points over SOFR. So bridge debt's coming in, you know, 10 to 12. You know, if you've got, you know, a deal that is a really difficult deal, a lot of construction, it's going to be more expensive. The lenders right now aren't liking heavy construction. They're not liking the long drawn out processes just because they don't know, you know, nobody really knows what's going to happen over the next year or two. And so the banks are getting really leery of, you know, heavy construction for that reason. They want to make sure that there's a way out, you know, when they're lending on projects. So, you know, rates are up. What's that mean? You know, there's a lot of things we could get into with that. But, you know, more or less, it just means that the you know, the values of properties are going to drop a little bit, and they are dropping a little bit. Cap rates are going up because the NOI is not there. And, you know, so people that are having to sell or having to sell at a discount, you know, something else that is kind of thrown in there is the fact that there's not as many deals on the market, whether it's multifamily, single family, or anything else. There's not as many deals on the market, but there's still a lot of buyers. So that's kind of holding the pricing steady. You know, so to see the real deep discounts like we would, you know, expect to see with these raising rates and things, we just haven't seen those yet. And you know, we might not see them, you know, but you know, who knows what the next year and a half, 2 years is going to hold. You know, if people get pushed in and the banks aren't able to refinance people and things like that as these loans come due, you know, we might start seeing a bunch on the market. And you know, as more hits the market, that's going to push values down and you know, allow people to get some better deals. But as of right now, we're kind of in a stagnant market just because you know, people aren't going to sell unless they have to. That's just kind of where it is right now. But you know, what I tell people is keep looking at deals, keep putting in offers, don't overpay. You know, so, and it's you know, how do you know when you have a good deal? The only way you're going to know when you have a good deal is if you've looked at a bunch of deals. So as far as, okay. I didn't realize you'd put this slide in there. I'd already talked about that. So yeah, look at the 10-year treasury, you know, add 2 to 2.25. You know, and that'll kind of tell you where your rates are going to come in at. Then there's a few places that you can go to find that 10-year treasury. And it runs, you know, as the stock market's open, it's going to move. And when a stock market shuts down in the evening, it stops, and then it starts moving again in the morning. So Fannie and Freddie are still looking to lend. They have money that they need to lend out. You know, they're still looking to hit their goals in the 5 to 50 unit range. They each are trying to lend about $2.5 billion, and hit the 18,000 units in that, you know, in that specific market. So they're nowhere close to hitting those goals just yet. They didn't hit their goals last year. You know, there's, like I said, there's a lot of things holding that back right now, but you know, it's a very fluid market. You know, things are changing every day, so who knows what's going to come. Small balance rates, Freddie and Fannie. This is kind of a guide on where everything's at here. You know, based like within the last week, this is where we're at. So if you want to take a picture, screenshot, whatever, go ahead and do that. I'll hold it on here for just a minute. But you can see the Fannie Mae, that's for 6 million and under. The Freddie Mac is 7.5 million and under for their small balance programs. And you know, that's for 80% leverage, 1.2 DSCR, and then 65% leverage at a 1.4, 55 at 1.5. And when you see that range, the 5.6 to like the 6.04, know if you've got an asset that has some low income housing or affordable housing, they would call it, you're going to be closer to that 5.6. You know, that kind of determines your rate range there on these small balance rates. They're looking to lend to people that are providing affordable housing. So, you know, if you got more of that going on, you're going to be at the lower end. Or if you have a new asset that's giving you, you know, that's in good condition and things like that, that'll bring your rates down a little bit as well. So I think our next slide will be jumping right into our topic. So our topic tonight is application to closing. And you know, some of the things that we'll talk about here, I run into borrowers as we get started in the process that are surprised by some of these things. You know, so hopefully you guys will, if you've never done a deal, you'll see kind of the process here, and it won't catch you by surprise as you come into it. So, you know, steps that you're going to that are going to happen before we even present an application. You know, when we get a deal from somebody, we're going to look at we're going to initially underwrite the financials, T12s, rent rolls. We're going to underwrite the borrowers, looking at the structure of the ownership. You know, how are they going to structure the deal? Where are they getting their money from? What do their, you know, personal financial statements look like? Their SREOs, or schedule of real estate owned. You know, so when you're looking to buy multifamily, you know, some of this information will be a repeat to a lot of you, but some might be new and not know it, so I'm going to repeat it. You know, when you're going to get you know, funding on a commercial real estate deal, you're trying to borrow $2.5 million. you need to have a net worth equal to or greater than the loan amount. So if you're going to borrow 2.5 million, you need to have that in a net worth between you and your partners. So it can be one person that has that, or it can be a group of you that has that. So, and then you're going to need to have some experience as well. So that SREO is really important as well. It's highly unlikely that you're going to be able to come in and buy a 40 unit deal on your first deal and not need a KP or a partner that has some experience. So, but they're going to look at the whole deal. They're going to look at the management plan. Are you planning on hiring a manager? Are you planning on self-managing? And Freddie and Fannie have stipulations on that. I think it's 20 units or less. You can self-manage if you don't really have much experience as far as the multifamily. They'll allow you to manage if you live within a certain distance from the property. You got to be within an hour. And then they have scales that they look at when they're underwriting these, and different parts of the country have different criteria as far as how you have to manage and things. It's different states and all that. So, but that's all the things that we'll look at before we ever present an application to you. To be able to jump into a deal. So the process, right at the beginning, once we send you an LOI or a letter of intent, we'll send you one of those once we do all the preliminary stuff. We'll send you an LOI, and if you like the numbers, you like everything, you give us the okay, we will start the application process. And we'll have all the things that we talked about, leading up to the application with, the way that you're structuring the deal, how you're managing the deal, the partners, just whole 9 yards will be in the application. And we'll need you to sign the application, and any partners will need to sign the application. And then along with the signed application to get the process started, we will need a due diligence fee. And that is usually 1% of the loan amount. So if we're looking at a $10 million deal, we're going to need to have a check for $100,000 for the due diligence. So that's caught a lot of people by surprise. I think there's gurus out there and things on YouTube that tell you never to prepay and do all these things. But when you're doing these commercial loans and you're moving up into the bigger deals, a due diligence fee is needed. And the fee that you pay, we'll cover some of the reporting that'll have to be done. We'll need appraisals, environmentals, property condition reports. If there is construction and things like that being done, there will be construction inspections done by the lender, and the money, and then we get into, the underwriters will dig deeper. The title work will start being done. So lawyers are getting involved and dotting all the I's and crossing all the T's, and all that costs money. And that's where the due diligence money comes in. Now, if something happens in that process, that stops a deal from closing, whatever money isn't covered or isn't used in the due diligence. So, take out the money for the appraisals and the time for the lawyers and all those things, and you'll be reimbursed that money if it comes to that. And then whatever is not used out of that money will just be put towards the purchase price. So, but the third party reports, the appraisals, environmentals, property condition reports. You know, if some of those things, if they have been done recently on the property, you know, some lenders will allow us to use those reports. Usually if it's, you know, right now at appraisal, if it's in the last 3 months, we can generally use it. You know, it used to be, you know, if it was in the last 6 months or 8 months, we could use them. But the markets has changed so quickly. You know, that appraisal that, you know, the value that was put on the property, you know, 6 months ago is not the same value that we're going to get today. You know, there's been a lot changed in that time period. So, you know, the underwriters will start digging deeper into the qualifications of the borrower, and also the property. You know, you'll have rent rolls that will be turned over. You know, they'll be looking into getting, you know, T12s, getting, you know, all the documents that are coming from the sellers. They'll be looking to get those certified by an accountant. They'll be looking at, you know, possibly doing, you know, inspections of the rent roll. You know, title work will be done. You know, all these things all have to take place. You know, so sometimes this process can be streamlined and be real easy. You know, we can close a loan sometimes in 45 days, you know, where other times we might be 75 days or even longer, because there might be something that they uncover in the inspections or the appraisals or something that has to be fixed, or you know, something in the title, waiting on things to clear and things like that. So
Can you hear me?
yeah, what's up?
Or a storm.
Yeah,
Storms.
yeah, yeah. We had some deals that were put on hold a while back because of a hurricane in Florida. So so all kinds of things can happen during the process. But you know, this page here has a list of just about all the different, you know, steps and things that we'll go through as we're getting ready to close the deal. So, and usually one of the final things that we're verifying and the lender's verifying before we close the deal is property insurance. So you'll need to pick up property insurance before we close. So.
And that's just a basic, right? Because each deal is unique.
Each deal is unique. That's just kind of a basic rundown. You know, we've got, I don't know, 5 deals right now in the works, and every one of them is just totally different from the next. So from the way that the ownership is structured to the just the whole 9 yards. So question and answer time. Anybody have any questions? Andrea.
Hi, Andrea.
Good to see you.
Hey guys, good to see you on Zoom.
Yeah, good to see you.
I really appreciate you going on this Zoom to explain the process from start to finish. So with my typical day job in multifamily investing for affordable housing, I'm used to the process, which you just mentioned, which is engaging the third-party reports and all that, but I'm not really familiar. And I think it's because of the way our team is structured where I work, but I'm not familiar with the actual closing process. So I'd like to find out a little bit more about what's involved in that closing process, because I have a team. We're fresh in the way we're working together, and I can help out with the process of like the application and the due diligence, but I'd like to know a little bit more about the closing. Can you dive deep into that about, you know, if you need any kind of to review the closing statement, or how you guys review that, or you know, invoices to be paid? Just can you elaborate a little bit more about that?
Yeah, I mean, they're on the closing, you know, there'll be they'll have that all set aside as far as what money went where, you know, all those types of things. You know, we're not the ones that are you know, putting the actual paperwork together. We're brokers. We turn all that over as far as as far as the details of everything they're looking for in the closing. You know, that's a group of lawyers that'll do that at the title company. But you know, it's their job to make sure that before everything gets there, that everything we've done up to that point, as far as gathering all the right docs, making sure that, you know, the things that are supposed to be certified are certified, making sure that, you know, the reports as they came in, that it's all, you know, conducive to what the lender's asking for to be done, and all that. So yeah, we're not really on that end of it as far as like the details of how everything has to be structured at the closing. You know, at that point, usually there's a team with the lender themselves that is going back and forth right with the title company. You know, so from our end, you know, as we're getting ready to close, we're getting reports back from our lenders saying, hey, we need this, we need that, we need this, we need that, you know, from the borrowers. But you know, so I don't know that I was much help with my rambling, but that's
No, that's actually pretty helpful because, you know, assuming some of us here on the call are part of a smaller team, let's say 3 or 4 people of a multifamily team, essentially, I'm assuming that we're going to have our transactional attorney help out with some of this process. And then our team internally has to review closing statements, make sure that you guys are paid in the process along with the loan and the application and all that, right?
yeah, well, our lenders take care of that portion of it, you know, and just know if you're closing a loan with a lender, the lender, it's of their best interest to make sure that everything is being done the proper way. And they want to make sure that you're going into the deal, you know, able to win. So, I mean, that's why they're going and doing all these inspections, you know, and all the things that they're doing. And, you know, that's one reason it's sometimes safer to buy a deal that you're getting funding for through a lender, because they're going to do this due diligence. I mean, the lender's your partner on the deal. You know, they want you to have success because it gives them success. You know, they want loans to come through their books, come off their books, and everything to be smooth. So if they miss something in the process, it doesn't look good on them, because that affects, you know, when they have a foreclosure, they go to borrow money. So, I mean, these lenders are borrowing money from someone else to fund these deals. And so when they have loans on their books that don't, that fall through, and they, you know, the people, you know, default and things like that, it looks really bad on them. You know, because when they go to a wholesale lender or one of these big banks to borrow money to lend out to investors like us, they're saying, hey, look, we've lent out X amount of dollars and this percentage has defaulted, or, you know, or we haven't had any defaults. And I mean, that's what they want to tell people, because then that shows they're responsible lenders, you know. So, you know, I like to caution people when they're going into deals where they're doing owner finance, because you want to know that that property you're buying is financeable. Not all properties are financeable. And if you're going and buying a property and, you know, maybe you work out a deal with the owner, you're buying the property on owner financing, you work out a deal where you're going to have him paid off in 5 years or 10 years, you're going to refinance, and you go to refinance and you find out that there's something wrong with the property, that you can't get funding for it, something environmental, or, you know, just something odd might come up, and you're stuck, you know, and a lot of times that owner that's financing the property might get the property back and keep your money, you know. So the lender is your friend on these deals, and they're going to be very, very stringent, and they're going to be hard to deal with, and you're going to hate life when you're going through this underwriting process. But know that it's you know, overall it's for the best, it's the best plan for the business to have them do this. So So any other questions?
There was a question on here.
Okay.
Mary Jane asked, which loans are coming due soon? Because we keep saying that when the loans come due soon. I keep hearing this, but don't understand fully.
Yeah, there's a lot of people that have, I mean, well, all commercial real estate, or not all, but most commercial real estate is bought, 10 years or less as far as the loan terms. And so, and over the last, 4 or 5 years, there was a lot of people buying properties, and then their loan terms were 2 years, 3 years, 4 years, 5 years. So the loan might be amortized for 20, 25, or 30 years. But the lender is going to hold your rate, and you're going to have a fixed rate for 2 years, 3 years, 5 years, whatever it is. So when we look back at our page here where we had, right here, you see a 5-year hybrid or a 5-year fixed. Those loan terms, that's a 5-year term. So your rate is going to be, that 6.04 it's going to be that 6.04 for 5 years. And when the 5 years is up, you're going to go to an adjustable rate. And so, a year ago, if you bought this property, your loan, from Freddie Mac might have been 2.5%. And so if you were on a 3-year term and you did the loan 3 years ago, November, in November, your 3-year fixed rate is coming due. And so your rate is going to jump from that 2.5% to, 5.5 or 6%. So let's say you're paying $100,000 a month on this property in debt payments. That $100,000 a month jumps from 2.5% to 5%. Your payment might jump from $100,000 to $160,000, $175,000 a month. And so if you were cash flowing $40,000 a month on that property, well, you're now in the hole by $20,000 or $30,000 a month. So that's what people are talking about when they're talking about the debt coming due and loans coming due, is they're going to go from fixed rates at 2, 3, 4% to adjustable rates, from 5, 6, 7, and 8%, depending on the loan product they're in. And that's gonna hurt a lot of people. And really, that's just a small, there's a lot of deals that are going to be going into that situation here over the next couple of years. And we're looking right now, if you've been watching the news, I watch Bloomberg. I try to watch Bloomberg in the mornings, and the guy from JP Morgan Chase, he was on there this morning, and he was saying that he thinks that we're looking at the Fed not pausing rate hikes until September. So we're looking at possibly June, July, and August having more rate hikes. So these people are just going to be getting squeezed tighter and tighter with their cash flows. And there's only so many months that you can lose $30,000 before you run out of money, and I'm just using those numbers. We don't know what anybody's numbers are, but there's only so many months that you can lose money on a deal before you just give up. And to go along with that, if the properties are in Florida, they're now dealing with their insurance rates doubling. Insurance has gone way up, and taxes are going up. If you've got a property in Texas, taxes, I've been seeing taxes in Texas have, we had a deal recently that fell through. They were under contract and we were working on debt, and our underwriters through Freddie and Fannie came back and said, they're only underwriting $83,000 a year in taxes, and the new taxes when they buy this are going to be $230,000. And so, that killed the deal. So there's a lot of things happening in the real estate right now. It's going to be interesting to see what happens over the the next couple years and how it corrects, because, it's going to correct itself and there's going to be people owning property still that are making money. But we're in a cycle now where there's going to be some people hurting, and then where there's pain, there's going to be people getting wealthy from the pain as well. So hopefully that answers your question.
Yeah, if you guys have a question, go ahead and raise your hand. Andrea, I see you have another question there if you want to jump on in. Go ahead and raise your hands, guys. These are the time. This is the time.
Yep, good, Andrew.
I was just gonna go back to when you mentioned owner financing, and we're seeing these types of deals happen. What part of that process do you recommend us still going through if we're going to basically do a closing with the owner, not with a lender?
Yeah, I would just make sure that you still do some inspections as far as get an appraisal, get property condition inspections, find out if they've had environmental inspections. I mean, it stinks to pay that money for these things. I know, especially when you're raising money and things.
They're so expensive.
Oh, I know.
Phase
I
one
know it is.
environmentals, like, I've seen it go from $2,000 to $5,000, and then the phase twos are always more expensive.
Yeah.
But I think, I'm just checking to see what you think and how you guys are involved in owner financing deals.
Yeah, and I mean, as far as with us, I mean, we don't really get involved. I mean, if we had one we was buying, yeah, I mean, if I found a good deal that was owner finance, I would buy it. I wouldn't shy away from it. But as far as like us, I mean, we don't deal with them as far as like helping with the due diligence. I mean, if you send me a deal that you're trying to work on, and we can kind of give you our opinion on it, but it's an uneducated opinion really, until you do the inspections and do all that. But one thing I would say, I would definitely make sure that you close those deals with a title company, and make sure that you do the title insurance and all that kind of stuff. I wouldn't skimp on any of those things. Just make sure that you're not cutting corners there. So.
There's some more questions here. Oh, there we go, Marcel.
See Marcel, go ahead, Marcel.
Just wanting to add a comment to that, and
Yeah.
I think besides, if you don't have a lender in obviously in the owner finance deal, right? Your attorney that you work with, should also advise you to go through all these due diligence items, right? So they have like a big closing checklist, so to speak. And as part of this closing checklist, there should also be like environmental survey, title work, all this stuff. So we did an owner finance deal last year, right? And we went through all that, and kid you not, I got asked numerous times the question from people around, and even the owner himself and the broker, like, why do you do all this work? Like, why do you do all this? And back then I wasn't sure either. I was just, that's what you're supposed to do, and I'm glad now we did. And everything checked out, which is good. But if there is no lender, I hope at least on the attorney side, who's going to be your main player that you work with, should also advise you to do that.
Yep, definitely. Thanks, Marcel.
Got it.
All right, Mario.
Hey, Jerry, how are you?
Good to see you.
Well, now you should be able to now.
Yeah.
So I just had a question. What is the loan rates that you quoted for Freddie? What does that loan balance minimum start at?
$1 million.
It starts at $1 million. And then is it Freddie, Fannie, or both that will allow you to have secondary financing? So like if I wanted to do owner financing on top of the lender financing?
Either one will let you do it. It's more common with the larger balance or their conventional balance loans. With that smaller balance, I haven't seen it much to where they okay that. But when you get up over the that 7.5 and that 6 million mark, and usually when you get up into the 8 digits is where you see that more being allowed.
Okay,
They like to see skin in the game.
I get it. And then I'm really interested because I like to play in the space of 25 to 75 doors. So I was super encouraged to see that note you posted about 5 to 50. I think that was with Fannie or Freddie. I screenshot it. So is that a space you'd encourage us to look at, since they are more interested in getting those size deals funded right now?
Yeah, and that is something they came out at the beginning of the year. It was actually the beginning of February, and made that statement that
Okay.
we're looking to do deals in the, we're setting aside $2.5 billion, Freddie and Fannie each, $2.5 billion each, for deals that are 5 to 50 units.
Okay.
And so they didn't, specify that they're going to give any special incentives. They just said, hey, we're looking to, lend on this asset class, and our goal is to lend this much for the year. So,
Okay. Well, I really appreciate all you do. Thanks,
Yeah,
Jerry
yeah.
and Shelly.
yeah, for sure. Glad to have you on here.
Yes, sir.
All right.
There's another one, Richard. Is he on here still? If he wants to ask his question.
Yeah, go ahead, Richard.
Richard Hall.
Oh, sure. Okay. Hey, can you hear me okay?
Yes.
Sorry, I was on my phone. I've been traveling, but anyway, I had a couple of questions, but I'll just stay with the first one about areas that you see lenders are negotiable on, and at what point in the process is the best process to negotiate. So whether terms or fees and other items that might be negotiable. I know it can depend on the type of lender you're working with.
Yeah. The thing that makes lenders negotiate is deal flow. So if you're somebody that buys a couple deals a year, if you're looking at like the bigger deals, you're buying, a couple multifamilies a year, you're going to find lenders that want to negotiate more. If you're buying one every year or one every other year, something like that, they're going to be pretty tight lined on their criteria. Or if you're doing like fix and flips, if you're one of the guys that's doing, a fix and flip a month, or closing one every month, or 10 a year, whatever, they'll get pretty free as far as negotiating with you. But if you're, like I said, it's all about deal flow. So if you're somebody that's repeat, they're gonna work with you more. And the same with us as brokers. I take deals to the same, main 3 or 4 lenders. We have access to 20 or 30 different sources for funds right now. But I deal with 2 main ones, and then probably 4 that I talk to on a weekly basis or daily basis. And those lenders are going to pay us more fees. They're going to treat us better as brokers as well, because we're bringing more deals. But as a borrower, deal flow is what they're looking for if you're wanting to be able to negotiate. So.
And that's across the board, whether they're agency or non-agency, bridge,
Oh,
or
yeah.
all that.
Yeah. Yeah. And the biggest things that you can negotiate on are, everything costs, so when you're looking at, I want more interest only, I want a longer interest only term, you can pay a higher interest rate and get that. If, you're looking to, get 0% closing, if you close a few deals with a lender, generally you'll be able to cut some of the cost on the closing costs. But like I said, it's all about deal flow. I mean, some lenders are going to be more stringent than others, and even agency debt. I mean, we're brokers, and we have 3 different agency lenders that we work with, because they all have their own fees that they add into the rates and stuff. And we'll use the 3 of them and price three of them when we get somebody coming to us for a deal. I know who usually gives us the best rates. and I'll go to them generally, but if I don't like the rates I'm getting from them, I go to the two others to price match and check them out. So we're doing a lot of that work for you guys if you come to us for things. You know, and just trying to get the best rates and terms for our customers is what we're doing there. But you know, there's a lot of fluidity. But if you're just coming and you're a one time and out borrower, or a once a year borrower, or, you know, something like that, generally you're not going to get the, they're not going to work with you. They're going to say, hey, this is what it is. If you don't like it, go somewhere else. So
Sure. Now, a corollary to that, everybody's looking for a low interest rate assumption. Do you guys get involved, or does that go directly to the lender in those negotiations or that transaction? And
that
I'm thinking that most of the lenders would rather have you pay it off, of course, but just wondering what you're seeing out there in those terms.
well, a lot of the assumptions are out there. People are, you know, using those assumption and the rates, the lower rates they might have locked in for 5 or 10 years, to help them get a better price for the property. You know, and I would caution, you know, just don't overpay for a property just because, you know, they have a good loan sitting there.
Definitely.
And a lot of the time, if you take on a loan that has a 9-year term, look at that loan close, especially if it's a Freddie or Fannie loan, because the prepayment penalties can be really high. So, you know, you'll see things that are talking about yield maintenance or 1%, you know, on a lot of the prepayment penalties. And if you get that deal and then you want to refi or you want to do something, you're going to have to pay a pretty big fee to get out of that loan a lot of times. And that just, you know, when these banks take these loans on, they, you know, they're guaranteeing a certain return to the investors that are buying the loans. So those go back into the stock market as mortgage-backed securities. They, you know, and they're all wanting to hold on to these loans, and they're expecting that rate of return. So if you sell the loan off or you refinance, that person that bought that loan is going to get hurt. So that's why they have these prepayment penalties.
Sure.
So be careful with that, and just you know, don't overpay just because somebody has a loan with a really good rate. You know, that you're still overpaying for the property, even if you might be cash flowing a little better right now, you know. So
Thanks.
yeah. But yeah, as far as your question with you know, we don't get involved in that process. You know, there's companies that service the loans. And they have a 1% service fee they have for you know, transfer of the mortgage and things. So, but I don't. Okay. Oh, we're over time.
I know we're over time. 2 more minutes here. There's a question.
Yeah.
Jerry, this person said, are you able to JV on a deal if you're also a mortgage broker?
You know, we are. You know, it's funny. We deal with you know, we're dealing with loan amounts right now. We're dealing with one at 32 million, dealing with a 5 million. I mean, we're dealing with these big amounts, and we don't have to be licensed or anything to do this. So there's no licensing, there's no state regulations on us in our work. But the people doing the home mortgages have all kinds of rules and regulations. So it's kind of crazy. But yes, and we've actually offered that to people in the past. You know, we charge a 1% fee to close a loan. If it's over $1 million, we have a 1% fee. And that 1% fee, I've seen a few deals that I've had people bring to me, and I've told them, hey, if we close this deal, you know, you're needing to raise money for this deal, I'll put half my fee back into the deal. And that, you know, sometimes that can be pretty significant, you know, 150,000 on a deal that we're talking about right now. So we'll put that back into the deal, and we'll actually be an LP on the deal. So So if you bring good deals to us and you need to raise more money, we're willing to do that. And if we see a real good deal, we'll put our whole fee in there, so. But we want to be part of deals too. So yeah, we'll do that. So.
And you can answer one more question that I know we get a lot sometimes, like some people have appraisals done on their own.
Yeah.
And then they come to us and they try to offer that to us. And well, how would you manage that if they have an appraisal already, like with the lenders?
Yeah, the appraisals, and a lot of times, people will get appraisals themselves sometimes, and other times we get appraisals from people who a lender called for an appraisal, and then that lender couldn't get the deal closed, and now they have an appraisal they paid for, and they bring it to us. If the appraisal is like within the last 3 months, generally we can use it. It used to be 6 or 8 months they would be good for, but right now in the current market conditions, 3 months, sometimes the lender will want to look and kind of, look at the appraiser and make sure that they're a qualified appraiser, and things like that. But, generally we can use them. So. And we have one right now that we're doing, that's a big high-end fix and flip, and they're actually calling for 2 appraisals. So it's always there. Every deal is different. So.
Yep.
Jerry, are you guys starting to see cap rates kind of rise as much as interest rates? I mean, are they starting to kind of level out at all, or does it still seem pretty unbalanced?
The cap rates are kind of all over the place. There hasn't been enough sales really to say, hey, this is what the new cap rates are. But cap rates are moving, and they have to. Most of what I'm seeing people, there hasn't been a lot of deals closing, right? Recently, we haven't seen many closed deals recently. But we've been seeing more people than ever trying to buy, and most people buying multifamily are trying to buy in the 6 to 7 cap range, and I'm seeing that. So when you guys are looking, we see a lot of older deals, a lot of older properties, C properties that people are trying to buy for 6 caps, and I'm also seeing brand new, A-class properties that people are trying to buy at 6 caps. So if you're buying something at a 6 cap, which one you want to buy? So I would say, if you're buying a C property, I wouldn't be buying it at a 6 cap. I'd be looking at those at, me personally, I'd be at like an 8 cap, 9 cap, and because I'm seeing these class A properties where people are, making offers in the 6 cap range. So. So I hope that helps. And I need to go. Things we need for a quote when you guys reach out to us. A T12 and rent roll. Send us the OM if you have it. And something big that a lot of people don't send me when they send me a deal is tell me what you're thinking on the property. If you have a pro forma that you've worked up on it, send that. Let us know what you plan to do with the property and what your thinking is, and that'll help guide us as far as when we're looking at the deal. We don't get these things from people right away, but before we can go under contract and go under application, we're going to need to see your SREO, PFS. We kind of need, before we go under application, we need to see a plan on, what the GP team looks like, the structure of your entities, all those types of things. So next topic, it's a repeat topic that we've done before, but what is needed to fund your multifamily deals? And that'll be June 14th. And next Wednesday, we'll be doing our market update. We'll post that video on the Facebook page, the MFC Facebook page, and then we'll be seeing everybody again on June 14th. We'll be heading out of town Friday, and be gone until then, but if you guys have deals, I'll still be answering my phone, and we'll still be working. We've got a travel trailer we're traveling in, and we've got Wi-Fi in there, so we'll be working. So all of our vacations are working vacations. So
Yeah, hopefully we will stick to the June 14th. If not, it'll be June 15th, but we're kind of like playing with that idea right now.
yeah,
of-
well, yeah, we're in the Grant Cardone's Real Estate Club, and they switched the club calls from noon to 8 o'clock in the evening on Wednesdays. So that's a big benefit of being in the club, is being able to be on those calls. So if they don't change that back, there's a lot of pushback right now on that. And there's a lot of people upset about it, so they might change them back to noon. But if they don't change them back to noon, we'll probably switch our Zoom to Thursdays. So, but we'll keep everybody updated in the Freedom Chasers Facebook group. So, but great to see everybody on here. Remind you to jump on the calls through the week. Sundays, the activation Zoom. Mondays, we got broker talks with Peter and napkin underwriting. And then the weeks that we don't have our calls, you'll see Victor will be on doing his deep underwriting. So, and here's our contact information one more time. Take a screenshot, picture, whatever you want to do there, write it down, and feel free to reach out for anything.